Good morning, August 30th. Mark B to B, survivor from Hurricane, whatever her name was. And this is Mark Putrino. He's back today and we're ready to go. Mark, how are you this morning, buddy?
I'm good, man. I'm pretty good. Um, just looking at this Hurricane Adelia, this is going to be pretty bad.
Dude, it's nasty. That was my phone.
How far is it from where you live?
I'm on the East Coast now. It went right past my old house on the West Coast near Cedar Key. I live about 20 miles from Cedar Key, is where I'm originally from.
Let's see here. I just want to
Little
check it.
town called Bronson. It's a nothing place.
I want to check this out before we go into the markets. Let's see here. Yeah, I mean, think of what Hurricane Sandy did up here, and I think that was only a Category 1. We
You see
lost
that
our
little you see that little hook right there on the right side of the red? I'm right below that.
over here, so it's going
Yeah,
north of you.
yeah, right here, just a little bit. I'm on the East Coast now, but it went right. That's right where I used to live. They're good, man. Those storms,
So
they
we got
shake the trees loose, but luckily around there, nobody builds in low lying areas, and pretty much everybody knows how to handle a hurricane.
we got this super moon too, which
Yeah,
is going
that
to mess
tide
with
was
the
bad.
tides.
Yeah,
And that's what happened during Hurricane Sandy. It wasn't that strong of a storm, but it's like it was it was at full tide, and the moon was whatever closer to the Earth than usual, so it had a lot of gravitational pull. So let's see here. So experts are worried the hurricane will yield even more treacherous tides than anticipated, thanks to Wednesday's blue supermoon. Hey Sean, hey Avi.
we call that a
Wow.
king tide.
Yeah. Well, there's always going to be these people that decide not to leave, and they're the ones that get stuck there. But yeah. Well, anyway, we don't really have big hurricanes up here usually. Although, knock on wood, I shouldn't say that because we're due for one. But anyway, let's go take a look at these markets. And I did actually not look at the markets at all yesterday because I had some things I had to deal with. So I'm looking at this for the first time since, I guess, Monday. How about that?
Holy
All right.
cow!
So let's see what happened yesterday. All right, so now the S&P had a pretty big move higher. All right, and this is what happens a lot of times when we break what we call a resistance level. I mean, that is a big move. Wow, up a percentage and a half. So
Check.
a couple things going on here, right? So we got resistance around this 443.50 level, and you can see it was resistance back here and resistance over here. So what is resistance? All right, resistance is this large group of investors who want to sell at or close to the same level. So that in this case was around 443.50. Now what happens is when the buyers finally overpower the sellers, a lot of times you can make these big moves because what does this show us or what does this tell us if the price gets above this resistance level? Well, it tells us that the investors who created the resistance with their sell orders are out of the market. They're either done or they canceled. So anytime you take supply off of a market, regardless of what market it is, it takes it's going to make the demand side is going to have to pay more.
I'll look into that, Sean, and find out what's going on.
So the theory is, or I don't know the theory. I guess it could be called a theory, but the common thought is that you get investors who want to maybe sell at a little bit of a higher price, but they see the resistance is down here. So they tell themselves, I really would like to sell at 445, but I see that there's resistance lower around 443.50. So I better reduce my selling price from 445 down to 443.50. So you get like basically what becomes like a little air pocket of sell orders in this range because people that wanted to sell in this range have reduced their prices. So within this range there's just not a lot of sellers floating around. So when the buyers come into the market, there's not a lot of sellers. So the sellers can kind of choose to offer at higher prices. And if the buyers want to buy, then they got to go out there and pay the price that the sellers want. So this is why when we get to support, we tend to make a rapid move higher. And when we break, or sorry, I should say, sorry, let me re-say that. When we break support, I'm sorry, let me say it again. When we break resistance, we tend to make rapid moves higher because it's just a lack of supply around it. This is all about supply and demand. And the same is true when we break support coming the other way. If you get below the support, what does that tell you? Well, the investor support is a large group of investors who are looking to pay at or close to the same price. In this case, it was the 443.50. But when the price gets below it, it tells us that those investors are out of the market. So it's like the same kind of a thing. There are investors who kind of want to, buy in this, just say this range here, but they see, oh, it got down to 443.50. That's the support. I really want to buy at 442, but it might get to 443.50 and rally again. So I better increase my price up to that. So then when you get below the support, there's effectively this air pocket of buy orders because the people that wanted to buy in this range have all moved, have a lot of the people that want to buy in this range have moved their prices up to here. So let's see if we can see another. Yeah, so here's an example here, right? Let's see. So resistance back here. We get to resistance and then we make a big move quicker, yeah, a quick move higher, I should say. All right, so that's the story with that. So now what we're going to do is we're going to go look at the second largest sector, or actually the largest sector, which is technology. Let's see what happened over there. Now, I would suspect a lot of this move higher without even knowing is probably because of Apple. Remember, we were watching the important things in the market to watch.
Yeah, it was.
And Apple.
It was Apple, Microsoft, Tech, and then financials ran yesterday.
Yeah, now you see this? So now this is not as precise of a level, but usually they're not really precise. I talk about levels, but it's really more of a zone. So we had this resistance over here around 176.50, and when we got above it over here, so a lot of the people that sold back here regret their decision to sell. So they tell themselves, hey man, I made a mistake. I'm going to buy my shares back if I can, but only if I can get them at the same price. So as we advance over to here, you got a lot of these remorseful sellers looking to buy their shares back. So that creates support.
And that
so
gap.
Ultimately, yeah, so this has a gap above it, so this could keep moving higher.
Mm-hmm. That's what McCall is. The reason I bought McCall's.
Yeah, so all right, let's see here. So when investors who wanted to buy around this range, and again, this is 176, the low here is 172. So we're only 4 points away on a $176 thing. So we're well within the zone. And then investors see, oh man, this thing is starting to rally. And then we get up to here and then we come back and look at where we were there. And it's like, oh man, I wanted to buy my Apple, but at 175, but this thing stalled out around 176. I better jump in there and we'll be willing to pay 177. And then maybe someone sees me coming into the market, wants to pay 177, and they want to pay 178, so forth and so on. And you get this snowball effect. Now, here's the gap, which Berlin alluded to. See, when something closes at one price and opens at another price, and there's no trading at the price levels in between, we call that a gap. And there's an old saying on Wall Street that gaps tend to refill. And it's true. And if you understand the psychological reasons why, or behind that, the psychological reasons behind that characteristic, then it makes it much easier to understand. So the stock never traded here in all these price ranges. Okay. Now, one of the main, let me show you on this screen. One of the main reasons why we get resistance is because we have, see, one of the main reasons why we get resistance is like here, as we're looking in the tech sector, is because you got these people who bought, who are remorseful after they buy because the price goes lower, and they tell themselves, I made a mistake. If this thing gets back up to the price I bought it at, I'm going to sell so I can get out at break even. So you can see support becomes resistance. Support becomes resistance. So remember, buyer's remorse can turn support into resistance. Now, when we have a situation like Apple, where you have this gap, well, guess what? No one ever bought the shares in here because it never traded there. So if the buyers keep coming in, and I would be a little hesitant to think they will in any kind of a meaningful way, but it is a short week. Basically Friday is going to be a non-day, probably Monday's a holiday. So there may not be a lot of people around. Let's see what the volume looks like. But when there's less volume, things tend to move more because there's less competition in the supply and demand area. I mean, if you got a lot of sellers, you could probably find someone who's willing to sell at a cheaper price. If you get only a few sellers, well, they're going to know that they could pretty much charge whatever they want. If you want to buy, you're forced to pay. What am I doing here? Move to new pane below. So, not really light volume, but not really big volume either. Anyway, if these buyers want to keep buying it, what's going to happen is they're going to come in and it's like, oh, hey, I just came into the market here. I'm willing to pay 185. Oh, wait, I can't find any sellers. No one's willing to sell to me at 185. You don't have these remorseful buyers trying to sell because the stock never traded there. So if it never traded there, then by definition, there can't be anyone who bought who's trying to sell. Now you get these same dynamics going on in sideways markets, buyer's remorse, seller's remorse. But if you're a big buyer and you come in when the market's in a range, it's like, all right, well, you're probably going to be able to buy your shares because you're in a range and it's been in there for a couple days or a couple weeks or whatever. And there's plenty of remorseful sellers or buyers around who are willing to sell. Now, in a situation like this, if you come into the market with a big buy order, like, I'm thinking like the institutional world, maybe you come in, you get an order to buy like 5 million shares. You come in here, it's like, all right, I got 5 million shares to buy. It's only a tenth of the volume. That's not that hard of a trade. I should be able to do it right in line here. When you come into the market here, oh, I got 5 million shares to buy. It's like, oh man, there's no sellers around. Down here, you can find sellers. But up here, it's like the sellers just aren't around. And someone might say, all right, well, just traded a couple hundred shares at 186. I'll sell you 1 million shares at 187. And then maybe I'll sell you my next 1 million shares at 188. And that's what drives the price higher, because you get these buyers that come in and they just can't find sellers. There's just not a lot of sellers in this price range. There probably won't be a lot of sellers. Everything I say has got to be predicated with a probably or maybe.
Taken with a grain of salt.
That's a kind of a tough question, Di. If a resistance level has been broken, what is a suitable entry point? Well, a lot of it depends on how aggressive you are in terms of, what's your risk tolerance. Like some people buy right on the breakout, and some people wait for the conversion to happen. And when I say conversion, let's just take a look here. If I can see if I can find a good example. All right, now let's just take a look at this XLK again. So some people would buy who are maybe more aggressive. And again, everyone has their own style. It's got to be something that fits your personality. Some people would buy right when we break out, maybe say right here or right here. Some people would say, it broke out. It would say, all right, it looks like it broke out, but I want to be sure that this conversion is going on from resistance to support, because markets tend to go up markets tend to go up slower than they go down. They tend to go up in stages, like a staircase. So an aggressive trader might say, hey, this thing just broke out. It gapped higher. I'm jumping in right here. I'm pretty sure that this resistance is broken and it's time to get in. Someone else who's a little bit more conservative might say, well, it looks like it broke out, but it could be a false breakout. I'm going to wait to see if the resistance converts into support. When things break out, there's usually, not always, but usually some kind of a reversion. And if the level that was resistance turns into support, the conversion has happened, and that's where I'm going to jump in. So notice how we come back down here and we get to the former resistance level and it converts into support. So someone who's more, um, someone who's more, not, I don't want to say hesitant, but has like a lower risk tolerance might wait for this to happen. So there's really not a good answer. It really kind of depends on your style. Like if we look down here, right, someone who's just buying the breakout might buy right here. And we don't know what their strategy is, if they're a short-term seller or a long-term holder. But someone who wants to buy on the breakout would just buy right here. Someone who's more conservative might say, it looks like it broke out, but I want to make sure it's not a false breakout. I'm going to wait to see if we get this little reversion or profit taking. And usually when you get a big move like this, you get some kind of profit taking. You're going to say, I'm going to watch this reversion and see what happens. Oh, look at that. The level that was resistance has converted into support. And we know that when markets are going higher, levels that were resistance to turn into support. And that sets the stage for the next leg up. So the aggressive traders would have probably bought back here. The more conservative or less aggressive traders would have bought in here. So yeah, I don't want to sound like I'm punting your question, but there really is no right set answer for that. It just depends on your style. Also, too, it depends on how quick or what your time frame is. If you're a day trader or someone who trades over just a couple days, you probably, this would be where you would jump in, because if you're a day trader, it's like, well, I don't want to potentially miss this move. Maybe it reverts, and things usually revert, but not always. So I don't want to risk it not reverting. So I'm going to jump in here, and then maybe tomorrow I'll sell it up here. Someone who's maybe longer term might say, well, I really want to buy my XLK, but I really kind of want to wait to make sure this isn't a false breakout. See, look over here. Remember, the red days are days where the opening price is higher than the closing price. So on this particular day, this stock, or this ETF, I should say, opened up here. Now, if someone was buying a breakout and they're like, all right, well, you know what? I'm going to buy it just because it's breaking out. Well, they would have lost money, because guess what? The stock came all the way back in, or I keep saying stock, but it was really an ETF. The ETF came all the way back in, and this is what we call a false breakout, or a bull trap in old days. That's what they called them. It looks like it's breaking out, but it turns out that it's not. So the person here who decided to wait for the conversion process wouldn't have taken the trade, because the conversion process didn't happen. But the person who is the aggressive kind of fast money trader would have jumped in up here, and they would have got, hopefully they would have gotten stopped out for a small loss. So when you're thinking about breakouts, you got to think, is this a breakout that's going to be sustained, or this is what we call the false breakout? And when you get a false breakout, and this is your classic false breakout, these in and of themselves tend to be good signals. Like, people have said to me, oh, I bought the breakout, but then it turned out it was a false breakout, and now I lost money. And I say, listen, go on the other side. You were thinking it was going to go higher. You bought some calls. Turns out it's a false breakout. Well, hopefully you got stopped out for a little bit of a loss. Now jump in on the short side. But think about buying the puts, because this false breakout in and of itself could be a signal. And like, the greatest feeling in the trading world is when you make money two ways on a single day on a stock. Like, you buy it, and it goes up, you sell, and then it starts going down. Like, you buy the calls, and then it goes up, then it peaks out, and you sell the calls and you buy the puts. But anyway, the good traders have to be nimble. You can't get married to an idea, right? Oh, it's breaking out. Oh, I was wrong. I'm going to sell here, take my loss. Oh, look at that. It broke support. Oh man, or it broke what could have been support because it was resistance. I'm going to jump back in on the short side here. And sure enough, it keeps going lower.
You really do feel on top of the world when you nail one like that.
Yeah. And what everyone's got to remember out there is that, this is not a game of perfection. You can't be perfect. The greatest traders in the world lose money. And the thing is, they just don't lose a lot of money. They get out of their positions that are losing at small losses. The traders who aren't so successful, they experience the psychological elements. It's like, oh, I like this stock. This stock made me a lot of money once. I'm going to just hold it forever. And then it starts going down, and they're like, I'm just going to hold on to it. It's a I'm not saying it's easy, but it's not as hard as a lot of people think. I think just having an awareness of it in and of itself is enough to help you out. Like, why am I making this trade? Let me take a step back here. And, am I thinking logically, or do I have a reason for doing this? Or am I just guessing? Or am I trading today because I'm bored? And it's like, all right, I got nothing else to do. I might as well go throw some money in the market. Well, that's a good way to lose money.
Yeah. Yeah.
And that's a pretty common thing, actually. It's okay to take a day off. I mean, like if you're going, and also too, if you're going through like a big adjustment in your life, like, I don't know, you're getting divorced or you're getting married or you're moving, or, it's a lot of times it's better to kind of stay out of the way, because when you're in those emotional, like, kind of frames of mind, it tends to, it could tend to for you to make mistakes, because mistakes generally come from emotions. I mean, it's one thing to be wrong about the market, because no one really is perfect. I mean, no one really knows what's going to happen. I mean, no one I've ever met. But the best traders, they understand that, and they don't try to be perfect. And they worry more about their own personal emotions than, all right, well, am I right? Am I wrong? I guess it just becomes kind of a, entertainment. I know people like talking about, I think the market's going to go up. I think the market's going to go down. But you got to be careful of that, because it subjects you, it makes you vulnerable to confirmation bias. All right. Like, you think you tell all your friends, oh, the market's going up. I just bought calls. The market's going higher, blah, blah, blah. I've been on this good streak for the last 3 months. Market's going higher. And then all of a sudden you start to see things that might say, or might give you the idea that, oh, wait a second, the market's not going higher. It's going to go lower. So your confirmation bias kind of would make you ignore those kind of things. And it would give you a tendency to ignore things that are contrary to your opinion. Now, like you all know, I worked for Steve Cohen at one point, and there were days where he would come in, and I remember these very clearly. He would usually get in around 9 o'clock, and the market opens at 9:30. But we would trade in the pre-market a lot, and he would come in and to be like, all right, buy this, buy that, buy this, buy that, and then the market opens, and all of a sudden he's like, sell, sell, sell. Like, he saw something that made him, I don't think changing your mind is a good way to say it, but he saw something that made him alter his opinion. Like, wait a second, I was wrong. I thought the market was going to go up, but I was wrong. I'm changing now. I'm going to the other side. I'm going to cancel all my buys, and I'm going to start selling everything I bought this morning, and I'm going to start shorting stuff. That's the ability to change, and a lot of that has to do with psychology. Because if you like, a lot of people don't like to admit to themselves that they were wrong. And I mean, no one really does, I guess. But the people that can admit to themselves, oh, I was wrong, I need to reevaluate this, they tend to be better off, because guess what? People can always be wrong, but the market is never wrong. So you ultimately have to let the market tell you what to do, right? You could be like, all right, well, I think the market's going to go lower, right? So we got this big move higher yesterday. Oh, we just got to where we were over here. I think that we're going to go lower. I'm not changing my opinion. And now say this comes in, and all of a sudden this important level converts into support. Well, I still think it's going to go lower. Well, wait a second. The resistance converted into support. That's the market's way of telling you it's probably getting ready to move higher. So, it happens in a lot of aspects of life, like dating, right? people start dating someone and they there might be things there that they are red flags, but it's like they kind of just ignore them or pretend they don't see them because it's like, oh, I really like this person. We had a good couple first dates. Now I see that, like, they stiffed the waiter, or or they shoplifted or whatever, and of course maybe you think those things are good traits, but just assuming that you thought they were bad traits, you might just kind of ignore them and be like, all right, well, I know this guy I started dating over here, just like, just stiffed the waiter, even though the waiter did a great job. But I'm going to ignore that because he's got a nice jacket on, or something along those lines. All right. Anyway, and this is really a good chart for seeing this whole thing I always talk about how it's, about how the market is really run by psychology. Look at this. So you got resistance over here becomes resistance over here. And that's because of our buyer's remorse. People bought back here and the price goes lower and they're like, ah, damn, if this gets back to my level, I'm going to sell. So when the market gets back up there, you get remorseful buyers selling. So resistance can become resistance again. The other buyer's remorse, not the other buyer's remorse, but a different way buyer's remorse affects the markets is it makes this support turn into resistance. So support becomes resistance, buyer's remorse. It's psychology. Resistance remains resistance. It's buyer's remorse, psychology. Now we can see down here, resistance becomes support. Resistance becomes support. Resistance becomes support. That's psychology as well. This is seller's remorse. People sell and price goes higher, so they want to buy their shares back if they can. So resistance becomes support because of seller's remorse. Now, how would support stay attacked? Well, it's also because of seller's remorse. There's people who sold here who regret doing so when the price jumps. And they tell themselves, oh, I'm going to buy my shares back if it gets back to my price. And that's what happened here. So buyer's remorse can keep resistance intact, and it could turn support into resistance. Seller's remorse can keep support intact, and it could turn what was resistance into support. All right, let's go take a look at our healthcare sector.
Hey, can I say something real quick, Mark? Hey, guys, that video that I put into the chat, that is a discussion with President candidate Ronald Reagan and William F. Buckley on the firing line in 1980. You need to listen to that video and just think about where we were at and where we have gone and where we are at again. Just listen to that, man. Thank you for taking the time to do that, though.
Yeah, it looks like it looks like I don't know, man. I just maybe Jill Biden has a lot of money, but if she did, we probably would have heard about it. But if you look at this mansion, apparently there's some book that all the lefties are talking about that's like talks about, it's called like What It Takes, I guess. And it was written when Biden was running in 1988, and all like this that ass face Scarborough, Joe Scarborough.
Yeah.
They're like, oh, like all of a sudden they think like, Biden's like Winston Churchill or whatever. But then they get to I was watching this on Greg Kelly last night, and then he gets towards the end of the book where I guess none of the leftists actually read that long, because they usually don't read big books. But it's talking about the opulence of Biden's mansion. And, this is the mansion he bought in 1974, 75. It's 10,000 square feet. It was owned by a member of the DuPont family. And they're just talking about the opulence of like the chandeliers and how big the rooms are and the indoor tennis court. And it's like, wait a second, you're Joe from Scranton, the blue collar guy,
Lunchbox
and yet
Joe.
your house has an indoor tennis court in it. I mean,
damn.
And then a few years later, he bought another huge mansion.
Well, I mean, listen, he's been selling America for 52 years. So, I mean, it's that simple. I mean, it's not hard to see now. I even saw somebody last night called him Joe Bribin instead of Joe Biden. Joe Bribin.
That's a good one. I was calling Beijing Biden for a while, but Joe Bribin. Yeah,
that's good, isn't it?
But this is what happens. It's like this dude got away with his stuff for 50 years, and it becomes hubris, and you think you can keep doing it. And the unfortunate thing is, he could have just retired and went off into the sunset 3.5 years ago, and we wouldn't even be talking about this. But now his legacy is going to be completely tarnished. Not that he even has a
Oh
legacy, but
no.
it, I think this dude is so corrupt that the way now we refer to people that are traitors as Benedict Arnolds, because Benedict Arnold was the traitor back in the
We're calling
Revolution,
Joe Biden's.
but a lot of people probably don't even know that, but they do know, like, oh, you're a Benedict Arnold. They do know that means traitor. I think in the future we're going to be calling, oh, you're a Joe Biden. It's just like you're so crooked. You're so crooked and you're so dumb. It's like when they ask Biden, like, have you ever talked to your son about your business deals? Why doesn't he just say, yeah, I have. Next question.
That's it. Answer the question.
Instead of saying something that's so demonstrably, provably wrong.
Have a good day, Sean.
All right, Sean. Yeah, it's like, all right, well, yeah, no, I've never spoken to my son's associates about his business dealings. It's like, well, Joe, don't forget, when they come to the White House, they got to sign in, dude. So there's written proof that they came there to visit you.
Listen, 5,400 emails with those pseudonym with those fake names. J.R. Beware and Robert L. whatever the last one was, Robert L. Peters. 5,400 emails. Mark, that's not possible. I mean, come on, man.
Come on, man. Well, my name is going to be Max Power if I ever need a pseudonym.
I like it.
Well, so it's Simpsons episode. All right, anyway, let's go through our healthcare sector here. And this is kind of in the middle of the range, but I just want to point out some of these same dynamics, right? Resistance becomes support. And it's like, why do we see these same dynamics or these same patterns on charts of different things? Like, why are we seeing the same dynamics of resistance turning into support in the healthcare sector, just like we saw it in the technology sector? And the answer is because what we're looking at is human psychology. And it's humans that are trading XLK and it's humans that are trading XLV. And they're susceptible to the same stuff. I mean, if we look in the commodities markets, let's go take a look over here at gold. Now, if we look at the commodities markets, we can see the same things, right? Resistance turns into support. Support turns into resistance. Resistance turns into support. And even though this is a commodity and this is gold, it's the people that are trading it experience the same emotions that people that are trading stocks do. We can see it in the crypto markets, which when I first started this, talking to retail traders like 2.5 years ago, man, I got so many questions about cryptos, and like no one ever asked me anymore. But now look at this, though, the same principle. What was resistance turned into support. And you could even say with support over here, it doesn't look like it on this chart, but if you see the lows, we got pretty close. So resistance turns into support because of seller's remorse. Why would resistance become resistance again? Because of seller's remorse. There's a lot of people who sold around here who are like, damn, I want to buy my crypto back, but I don't want to pay more than I sold it for. And if it gets back to around my price, I sold it around, say, 25,800. If it gets back to, say, 26,000, I'll kind of just buy it back. And here we have our phenomena of our fast move up through price levels and then fast move back down through price levels. And that's because when you rip really high through these price levels, you don't get enough time for this vested interest to build. So there's not a lot of people who sold in here who are going to want to buy on the way back down because we just blew these levels through these levels so fast. So if you move, it's the same principle as what we talked about before with the gap. It's not a gap, but it's the same principle. Like in a gap, there are price levels where there's no trading. Well, in a rapid move like this, there is trading, but there's just not a lot. So you're just not going to get this whole big group of people that sold are like, damn, I want to buy my crypto back. So a lot of times when you get a rapid move quick or a rapid move higher, and then you eventually reverse and come back to those price levels coming the other way, you can get a quick move lower back through those levels. And you can even see here, right? This is, now we have fast move lower, fast move higher. There's not a lot of people who had time to buy in here who are remorseful, who are going to be trying to sell on the way up because it just didn't spend a lot of time there. So fast move higher. Then we get into a range. Now in the range, the same things are going on. You get the seller's remorse, or you get the buyer's remorse, but we're spending more time trading around these price levels. So buyers and sellers who are remorseful aren't going to have as hard of a time finding the other side of the trade. I mean, like, look at this. This is a really good example here. Fast move up, fast move down. But when you're in the range, it's like you come into the range and it's like, oh, I got all this Bitcoin to buy or sell. We're in a range. It's like, okay, well, there's a lot of sellers or buyers around and it's easy. Here, it's like if it comes in, you're like, all right, you know what? I'm a buyer. I saw we made a fast move higher through these price levels before. I'm going to back up. I'm going to be a very cautious buyer. Maybe I'm willing to buy, but I'm going to buy at a discount. The sellers are like, damn, I can't find any buyers around. Maybe I better accept this guy's discount bid, and so forth and so on. And you get this rapid move lower. So it's pretty, it's an interesting phenomena. And if you look at this stuff through the prism I always talk about of psychology, it's easy to understand. But if you look at it through the prism of what, Joe Kernan is saying, or, what Varney is saying, and I like Varney, it's like, what's going on here? It's down 1.2% because, because of whatever, is going on. I can't even think of a good example. But crypto's down 2% because Miami's in the wake of the hurricane, or whatever.
Well, when I was in the gas business, the hurricanes would change the price of gas. They don't as much anymore because now it's baked in that the prices change, fluctuate constantly. But then 20 years ago, it was hurricanes would make the price of gas really explode around here.
Huh. Well, I guess that's not surprising, but that's the supply and demand, as we see it in the stock market. It's like, all right, well, hey, you got gas to sell and there's going to be a big demand for it. So you see all these, it's like you see these buyers coming into the market. Why sell to the first buyer that you see? Go to a higher price. Like I was watching Pawn Stars whenever, and it always amazes me when people come in and like Ricker's like, well, what are you looking to get for it? Oh, I was thinking 8,000 or 9,000. So wait a second. Why would the guy pay you 9,000 if you're willing to sell it at 8,000? You know what I mean? And if you wanted to sell it at 8,000, why don't you say I want to sell it at 12,000? Like, why do you show your first? Why do you show your hand on the first time around? Like that's kind of a unwritten rule in trading, at least in the institutional world. It's like the first bid is never the best bid, or the first offer is never the best offer. Whatever the person tells you they want to buy or sell at, you got to go under the assumption that they got some room to move. And listen, I'm willing to sell at 35. Meanwhile, the guy's thinking, gee, if they pay me 34.80, I'm going to be ecstatic. And it's like, all right, you know what? It's at 35. I'll tell you what, I'll pay you 34.90. And the guy's like, all right, done. So I like watching those game shows where because it shows like that, or the game shows, because it just shows how when it comes to money, people just don't think rationally.
Right.
All right, so here's our financials, and this could put a little bit of a top on the market here. This little bit of support here was probably going to become resistance. But I don't know, man. I don't know where I was out of touch yesterday. Was there any kind of...
No, there was no news for anything. There's a gap there on that XLF too. There was a gap on that XLF.
Oh yeah, well that's not really that. It's a small gap, but yeah, it could be the same principle.
It'll draw it up.
Yeah. All right, let me just go see what's in the news here today.
I was more prepping for the hurricane, trying to clean up the yard and get everything stowed away just in case the wind came this way. Because you never know; those things are they're tricky. They're like spaghetti strings. Sometimes they'll go out into the Atlantic, turn around, and come right back across the state.
Yeah, well, I'm starting to think, man, I got to get my generator repaired, and I got some propane being delivered here in a few days. But where we live, there's no we have wells, so if the electricity goes out, like we have no water.
Yeah.
I wouldn't really mind, because that's the biggest thing. I mean, I could live without power for a few days if we get water.
Man.
But when Hurricane Sandy came around, we were without power up here for 9 days.
Mark, when it was Charlie and those ones in 2004, I went 38 days without power between those 4 storms.
38 days.
38 days. It sucked. I was going to the local. Everybody else around me would have power, but it was just me and one of my neighbors was on the line, and it was flipped. So all the damage was so bad it took them forever to find us. And so we would go over to the neighbor that he actually left his house and left all his shit out and left and went out of state for the hurricane, and it blew into my yard while I'm cleaning my place up and getting it nice. He has power during the storm. I don't have any. And then he comes back and I had to bum water off of him for 3 weeks. It was terrible. It was really rough.
Why don't you have a generator?
Well, in that time I didn't know about it. It was 20 years ago. We didn't really have generators back then. Nobody was pre-wired for generators or anything like that. And we never really had, and that was the first time we ever had 4 storms that hit us in 6 weeks.
Yeah.
Those things were crazy.
Around here, man, it's like when all the power goes out, there's so many generators. You would think you're at an airport. It's just like, I mean, it drives you literally to the brink of insanity.
Yeah, for most places don't really. I mean, some people still don't even have an air conditioner down here, Mark, and you need it.
Yeah, I couldn't live down there with. Well, I mean, I could. If your body acclimates to it.
Yeah, once you get used to it, it's not. I mean, it's not comfortable, but it's not horrible either.
Look at this sleazebag Bob Menendez, man. This is another guy who should be in jail.
Long time ago.
New Jersey senator. It's just the sleaze. All right, let's see. I got a question from Di here. How did the market manage to turn green despite the negative news reported yesterday? Is it just buyer or seller's remorse? Well, here's the thing. Most of the time, I don't know what negative news you're referring to is, but the vast majority of the time when the media is trying to attribute a market move to something, they are wrong. And that's because they don't understand, and they, can you let me know what the negative news was? Because I was out of touch yesterday. I didn't have a chance to look at the market at all.
Yeah, and I missed it, Di. I'm sorry.
But the vast majority of the time, the market, when it moves on a technical, right? The news that really can influence the market has to do with interest rates, because interest rates directly impact the bottom line. Now, I would say, without looking at the news, I think the reason why the market rallied is because Apple held that support. And let's go back to Apple here. And when there are traders who want to buy and they're watching this, and they're watching it trade around these levels and they're waiting for it to come lower. So some of them say, well, first of all, a market goes lower because there's not enough buyers or demand to prop up the supplier to absorb the supply. So these traders are watching and it's like, wow, wait a second. The market was moving lower here. Apple went from 180 down to 175, but it stopped going down. So that must mean that there are new buyers coming into the market. So I better go pay a higher price, because if not, I'm going to miss out. If there's someone who's willing to pay a higher price than me, the sellers are going to go to them. So you get this bidding war where you get investors are like outbidding each other, and it starts a snowball thing. So I would say the market was up yesterday because Apple held this support. It was confirmed that this was support here. It got a little bit below, but that's not unusual because support levels tend to be a little well less defined, because we get to support because of selling, right? We get to resistance because of buying, and selling is a much more, markets go down faster than they go up. And this is a good example here. See how we go up. And that's because people sell based on emotion and the emotion of fear, and people buy based on the emotion of hope. So I would say, regardless of what the news was, that's what I would think. Because I think in the mindset of a trader, and it's like markets move based on supply and demand and psychology and technicals. They generally don't move because of news. There's, in the institutional world, there's not a lot of people. I don't think there's anyone actually that I know who sits around and says, CNBC just said that, Hurricane Idalia got upgraded from a 3 to a 4, and we better go sell. I mean, it just doesn't happen. Maybe for some retail traders it does, but in the institutional world it doesn't. AI startup boom is facing a reality check. Venture investors are realizing. All right, I saw Nvidia was up yesterday, and I don't know why. right. So, I mean, it was a decent move higher, but it didn't surpass its former highs. But there's a little bit of follow through this morning. But this is going to be another thing to watch for a reversal. Unfortunately, the options are probably going to be extremely expensive, but this thing fundamentally is just overvalued and so forth. All right, so Di, let me know if that answers your question because I'm going to get going in a few minutes.
Hey guys, thanks. Like and subscribe and share the stream. We keep forgetting to say that every day, but thank you so much for showing up with us every day and spending time with us. Thank you.
All right, everyone. I will see you all tomorrow morning.
Have a great day, guys.